But today we've got a special guest, Grant. You work on industrial properties.
Mhm.
And come on in, tell us a little bit about your group and how you operate.
Yeah, that's great. Well, thank you so much for having me today and appreciate you letting me present. So I'll get jumped in here. So do I have the ability to share my screen? Yes.
Yes. And if you have any questions for Grant, feel free to put them into the chat. And then
Mhm.
Grant, I'll monitor those for you so you don't have to and you can concentrate on your talk. And then I'll just
Perfect.
judiciously interrupt you if a question is particularly on topic or, if it's a good point in your talk to ask a few questions.
Perfect. Works for me.
All
All
right.
right. All right. Can y'all see
Yeah.
my screen now?
Yep.
Perfect. Perfect. So we'll go ahead and get into here a little bit. So appreciate you guys having me on this Friday afternoon. So what we're going to talk about today is flex industrial. My name is Grant Reeves. I'm with Stoic Equity Partners. We invest in value add multi-tenant flex throughout the Southeast. So we're going to talk about a little bit of what is flex industrial, why is that different than other types of industrial, the different styles of flex within that subcategory itself, and then discuss what the opportunity is currently in flex, why we invest in that, where we see value, how we add value to these properties, go over a quick case study of a property that we've owned for a little while, and then also go over a recent purchase, just kind of showing the different ways that we invest in these deals. Um, so as I said, my name is Grant Reeves. My business partner is Jeremy Friedman. We were longtime commercial real estate brokers based here on the Gulf Coast. We're down near Mobile, Alabama, so kind of near Florida, Alabama kind of area. And I had a long career in mainly limited service hospitality with Marcus and Millichat, and so sold hotels throughout primarily the Southeast, but a little bit into the Texas, Kansas, those kind of markets. Jeremy did a lot of triple net retail brokerage, so a lot of Dollar Generals, a lot of O'Reilly Auto Parts, those kind of properties. And as brokers, we decide always want to get on the principal side. So through COVID, actually, we kind of put our heads together and started working on Stoic Equity Partners. And so we did our first deal in July of 21. We owned about $87 million worth of assets, about 900,000 square feet, and managed about 30 million of outside capital. We have a small team, but we have in-house accounting, in-house asset management analysts, and then also have a director of project management that runs with our development stuff. So that's a little bit about us, our portfolio. We have a fund as well as we do direct syndications. Our fund was launched at the beginning of this year. We have 3 properties in that fund, one in Louisville, Kentucky, one in the Jackson, Mississippi portfolio, one in McDonough, Georgia. Outside of the fund, we own another 10 assets that are for self-storage is where we got started before we found Flex Industrial. And then we've now done, I guess, about 9 more Flex deals. So on total, we have about 700,000 square feet of Flex Industrial throughout the Southeast, and another, I'd say, I guess, 250,000 square feet under contract as well. So, but kind of diving in here, enough about us. So Flex Industrial, this is office warehouse complexes. So these buildings are primarily, let's call it 50 to 150,000 square feet, made up of a lot of individual units of different sizes of office or at different ratios of office to warehouse. So we might have a building that's 100,000 square feet. It might have 20 individual units in it. It might have 20 units that are all varying sizes, anywhere from 22,000 square feet up to maybe a 120,000 square foot user. So they're very flexible buildings. They're very flexible layouts inside. That's why they call it flex industrial. These are mainly located throughout business parks, kind of on the outskirts of town traditionally. But as these markets have grown, they've become more infill locations. And so more kind of retail corridor type properties is what we usually look for. It's a lot of like we always want to be near wherever the new grocery is going, where the new housing's going, and just kind of the wherever the growth is inside the market. The construction's either going to be concrete tilt-up construction or metal building, usually. Sometimes it'll be a metal building with a brick facade or a stucco facade on it, but that's kind of the typical construction type. And typical users are going to be, they're very wildly, but a lot of service-based companies, so a lot of general contractors, a lot of plumbers, as well as some technology companies, FedEx, logistics, some life science space. So it really varies wildly, which is great. And that's why it's, again, called flex, just because it's flexible. So getting a little bit heavier into the actual characteristics of the properties. Each unit will have both office and warehouse in it. Again, it varies wildly on how much office to warehouse you'll have. You want more warehouse these days, obviously coming through COVID. Office space is not nearly in demand as it once was. And so we like to look for buildings that are at least 50-50 office to warehouse if they're stabilized, but also that is a value add strategy that we have where we'll go in and pull out office space and increase the warehouse to make the spaces more appealing. We usually look at buildings anywhere from 50,000 to 150,000 square feet, but you will see multi-tenant flex deals down to maybe 15,000 square feet and up to 300,000 or 400,000 square foot big parks. Typical lease terms of 3 to 5 years. We kind of went over a little bit already, but you have a different mix of both tilt-up construction, so kind of more traditional industrial construction, as well as metal buildings. This property here on the right, that's a property we own in McDonough, Georgia. We'll actually review a little later on. But that's metal buildings. It's about 90,000 square feet in that portfolio, but they have brick facade built in the late 90s. So that's kind of a typical deal of what we're looking for. On the tenant profiles, we have a lot of logistics firms, so FedEx, UPS, general trucking companies. We do have online stores, so as e-commerce has continued to rise, we've seen that come up into our in our buildings as well. So we'll have a few like online boutiques, like women's clothing, so they post on Instagram and TikTok, and then they drop ship product out of the back of the property. So that's going to be a bigger and bigger thing. Another tenant we have is a grill parts manufacturer that they actually just use their flex spot to distribute out of. They don't manufacture there. So a lot of e-commerce on the service side. On the housing, a lot of HVAC cleaning companies, GCs, termite pest control, any kind of foundation work, really wide variety of these service-based companies are definitely our largest users, primarily around the housing and construction industries. We do have some specialized life science space. For example, we do have Tyson Foods is a tenant of ours on one of our properties, and they have their warehouse built out as a laboratory, and they do food safety testing there. So they test their chicken packaging and that kind of thing. We also have CVS as a tenant of ours, and they have a compounding pharmacy where they mix IVs as well as put together prescription packs for the entire state of Mississippi. So a little bit more specialized, like kind of science space as well in these warehouse facilities. And then every one of them, it seems like, has some gym in them, cheer, dance, some user like that, car graphics, auto repair. See some churches every once in a while in the flex deal. We have a couple of churches that are tenants. So it's a wide variety all the way through of who can use these spaces. It's usually somebody who just needs obviously commercial space, and needs some warehouse, but also at the same time doesn't have to have a huge retail corridor. So anybody who's doing shipping or maybe like kind of even destination retail that they do a lot of distribution out of is another good fit for a flex facility. And then we're talking about the markets a little bit. So this is Hoover Homewood in Birmingham, Alabama. And so this is major interstate here. You have a retail corridor right in this area, a lot of housing surrounding this place. Then you have a big commerce park here. And the highlighted yellow pieces are the flex industrial parks or properties throughout this larger industrial park. So most of what you'll see in an industrial park is going to be, this kind of traditional. I'll zoom in here a little bit. Kind of your traditional large manufacturing distribution warehouse. We are looking for more of the smaller multi-tenant kind of stuff. We don't invest in the large single tenant properties, but usually we would be surrounded by the larger single tenant stuff. It's usually going to be within a commerce park. They will sometimes be a little bit more in the retail corridor, which is what we like to see, primarily due to the fact that we like to be near affluent areas where nice shopping is, because that's where someone's going to want to spend most of their time. This is where someone works day in and day out, and they also want to have their office near where they live. So you want to be kind of in the nicer area of town, because that's where your business owner that maybe owns the HVAC company is going to live, and they want to have their office warehouse be close to where they reside. On the debt side, they're very active on the debt side right now. Obviously, there's some problems throughout the commercial real estate industry on certain product types that are hard to find financing. We have not seen that in flex industrial. Our market's very strong. We mainly deal with regional banks. We do some life insurance company debt as well as CMBS debt. Life insurance and CMBS are a little bit better for stabilized assets. We are, again, more of a value add firm, so we usually have a construction component to what we do. So we mainly use regional banks, but the liquidity is definitely there for flex industrial. I also wanted to say real fast what flex industrial is not. We're not bulk industrial. So this is not large scale Amazon or Walmart, Milwaukee Tools, just to name a few, or a huge FedEx facility that's maybe a few 100,000 square feet and it's one or two tenants and it's in a huge tier one market. That's not what we do. There's been great space and people have done well in that asset class, but it's not really what we're playing in and not what we do. I just always want to point that out just because people hear industrial and a lot of times they think about the really large warehouse piece, but we're kind of a subset of that. So real fast, we'll kind of go into two different kind of designs that we usually see. This is kind of more the traditional flex side. This is what we like to see, which has an office front here. This is a building that we own in Mississippi, but has office kind of entrance looking on the front and then roll-ups, dock highs in the rear. Larger tenants are going to like this space. So you'll have tenants up to maybe 10,000 square feet in these type of buildings. It's a little bit nicer of a flex place. So this is where you're like, for instance, we have Terminex, Hillrom, ThyssenKrupp elevators are in there. Kind of your larger, kind of more blue chip tenants are going to want to be in this kind of more traditional flex space. It has higher roll-ups, higher clear heights in the warehouse, everything like that. They lay out kind of like this. So you have your rear entrance here to your warehouse, and then you have your office entrance here. So we own these three buildings, just an example, but these are tilt wall construction, very nice. A lot of very large tenants prefer this type of space. And then this is kind of how it's broken up throughout. This building is actually now broken up as well, but as you can see, I'll zoom in here a little bit for you. You'll have 3,000 square foot users, 1,500 square foot user, 4,500. Going over here, you have a couple of 9,000s, 10,000, 9,500, 8,500. So you can meet a lot of needs here, and you can change out these walls how you need to be able to meet the tenant's need. We'll see a lot of times where we'll come in here and demolish that interior wall, make this one big space like that. But it gives everyone plenty of dock highs, plenty of roll-ups, as well as good entrance into the front of their office space. And then this
would now be a good time for a couple of questions?
Yeah, go ahead. Sorry. Yeah.
All right.
Feel free.
Oh yeah, no problem. No problem. So we've got William here saying, in fact, he was going right into what you just mentioned here. How easy is it can the area inside of the walls be moved or adjusted?
Yes, usually these are clear span buildings, so there's a firewall in between them, but you can connect spaces relatively easily. Because structurally, it's not in the interior walls.
And then I wanted to ask you, in your contracts, who bears the cost of that? Is that the tenant, I assume?
No, so it really depends. And so if you have a tenant come to you and they're going to want you to do it, you could do it and do it as part of your TI allowance, your tenant improvement allowance, but you are going to charge a higher rate because of that.
Yeah.
So it's kind of a business decision of, hey, we can get maybe $11 a foot if we do the work and pay for it, or they'll pay us $8 a foot and they'll do it, kind of thing.
Okay. But in general, in your contracts, I assume that most of the expenses these are triple net leases, right?
For the most part. I mean, you will see modified gross as well. We prefer triple net. That's a strategy. We like to roll people to triple net.
Okay. And so which expenses are actually borne by you as a company as opposed to the tenant?
So on a triple net basis, we're passing through common area maintenance, taxes, and insurance, obviously. Yep. They're paying for their own utilities. You will still have some expenses. Sometimes there will be I'm just trying to think of an example, but like you're replacing a roof, a lot of times that will not be a pass through to the tenant. A lot of times larger structural pieces like that will still be borne of the landlord. And then you do have some modified gross leases that we deal with where we're paying the maintenance of the operation, taxes, insurance, and the tenant's just paying their own utilities. That's obviously not as ideal, but we do see that from time to time.
Okay. Glenn is asking, are you the developer and the operator? If you're the latter, are you offering services such as receptions, network? When you say network, I assume you mean internet networks, right? Networks, maintenance. What services do you provide to them?
Yeah, so we're an operator. We're not a developer in the space. We have developed other stuff, but kind of one of the big things about flex industrial is that you can't really build it right now and be able to make numbers work. So that's why it's such a good value add strategy. But yes, we do acquire these assets. and we're a private equity company. We raise money, buy these assets, and we operate them. We do use third-party property management. And so the third-party property manager is going to handle the landscaping, the pressure washing of the buildings, making sure the HVACs are running, kind of the larger components, and then the tenant's responsible for kind of their walls in space.
Is there any costs associated with restriping the parking lots, or I know parking lots can be fairly large for an area
Yeah.
like that.
Yeah,
Outside
that's a big thing that
landscaping,
we
which is probably
do.
minimal.
Yeah, so most of the deals that we're doing, we're buying with some sort of construction loan component.
Yeah.
So whether that's it needs new roofs, it needs new landscaping, there needs to be some sort of renovation, right? It's value add. Like we need to be able to improve the property somehow. But we also do seal and restripe a lot of parking lots is a big one that we do. So we usually will wrap that into our deal on the front end, wrap it into our construction loan, and then pay for it like that.
Okay.
Mhm.
Mike is asking, how do you decide on the location of your next flex purchase? Which parameters do you take into consideration when it comes to your buildings?
So we primarily invest in secondary cities in the Southeast. We do not invest really in the huge high growth markets. So we don't really invest in like Orlando, South Florida, Nashville, Austin, Texas. We would rather invest in like the Birmingham, Alabamas, the Tallahassee, Florida, Jackson, Mississippi metro, Memphis, Tennessee, kind of markets that are about 1 million people in the metros, what we look for, and then that are a little bit more stabilized of markets. The reason we do that is we can get a little bit better yield going in. So we're not betting as much on, having a really low cap rate on the exit, more so more of a basis place going in. And we want to be within those stabilized markets. There are high growth little nodes throughout there. So like in Jackson, Mississippi market, Ridgeland is a suburb that we invest in. We're right next to a brand new Costco, brand new Chick-fil-A. That's kind of what we want to look for is wherever in every market, there's some growth. We want to be wherever the growth is.
Okay. And then I know you mentioned earlier that you use third-party management, and you just mentioned a variety of different cities. How do you identify the people that you're going to work for your management?
On the management side, so usually in most of these markets, there's really one to maybe three operators that are really good at flex industrial. That's usually going to be a Cushman Wakefield, a Colliers affiliate, an NAI affiliate. They're a national real estate brokerage firm that we're usually buying the assets through them off market, but through brokers. And then they're the management company as well. Like for instance, in the Jackson, Mississippi Metro, NAI is really who does most of the management for flex industrial properties. So that's who manages ours as well.
Wow, that's a great deal for the brokers have a good thing going on there where they can sell you a property and then sell you the
Mm-hmm.
services to
It's
to
why we see
manage
a
it.
lot of really good deals before anyone
Yeah.
else. That's because they know that. Mm-hmm.
Okay. I'm gonna. There's quite a few other questions, but I'm gonna hold them for a little bit to let you
No
continue
worries.
with your talk.
Sounds good. So jump back in. This is kind of a typical floor plan of a suite. So this property is this unit is a little bit heavier office, as you can see. But it'll have a roll-up door and usually a dock door back here. So you have one of each, and then has just general office throughout. We really like this deal, even though or these type properties, even though they do have an office component. If you have to have a large part of your work area be warehouse, you really can't go work online. You really need to have the space to be able to whatever you do, manufacture or logistics or whatever your service is. You can't go work completely over Zoom if you need to have a large part of your workspace be warehouse. So it's a little bit protected from the work from home trend, which has been nice. This is another kind of different type of flex industrials property. This is more people might call them contractor garages. They're primarily warehouse space. They're smaller. These are going to be more of your kind of local landscape companies, something like that maybe they need a single office and mainly a little warehouse. These might be 1,500 to 2,000 square feet total with maybe 400 square feet of office. And as opposed to the other property type we're looking at, be a little bit larger size, maybe 5 to 10,000 square foot suites. These are going to be cheaper and kind of more your localized tenant base. But this is kind of how this deal lays out. We don't own this deal. It's a deal in Texas. It was just a good example that I wanted to include. But all the spaces in this park are exactly the same size. So I think they're 1,500 square foot units. So you could have 3,000 square feet or 4,500 square feet, but they're not as flexible as some of the other kind of more traditional flex buildings. This is kind of what a typical floor plan of that type of property looks like. You walk in, you have a little single office, little bathroom, and then just a bunch of warehouse with a roll-up door on the front. These aren't going to have dock highs. This is not where your larger tenants are going to go, but this is almost a quasi kind of storage unit, kind of someone who's moving out of storage unit that wants to have a little bit more of office is going to go to more of this kind of product. So that's kind of what Flex is. Kind of getting more into why we invest in Flex. It's really high demand and it's low supply. Over the past 20, 30 years, most of the development's been either more traditional bulk industrial like we looked at or traditional office prior to COVID. But this kind of in-between flex space has not been built. We're buying it well below replacement cost. On average, we've spent about $93 a square foot throughout our portfolio to build new constructions anywhere from $150 to really $180 a square foot. So we're buying them well below what it would cost to replace them. Our vacancy risk is mitigated by multiple occupants. It's kind of the same way that self-storage and multifamily don't rely as much on one or two large tenants. We're kind of the same way. We'll have a portfolio of buildings that has 30 tenants in it. One or two end up vacating for some reason. It's not going to be a huge hit to cash flow. I mean, it will obviously affect it, but we can continue to operate, continue to cash flow positive. And it's not, the entire business plan is not predicated on one or two tenants staying. And also, I kind of mentioned this earlier, but it's where business gets done. This is a space that if you need to have a large part of your workspace be warehouse, you're not going to go work completely over Zoom. You need to have a physical location, which will help demand moving forward. On the value add side, so we're buying older properties, usually 80s and 90s vintage, and doing some sort of value add. So whether that is increasing the rents or increasing the occupancy or both. The way we usually do that is one of two ways. One is reducing the amount of office space. A lot of these were built out as maybe 70 or 80% office over the past couple of decades, primarily just because you could get more prior to COVID for office space than you could for warehouse space. So it was more advantageous for the landlord to have maybe 8,000 square feet of office, 2,000 square feet of warehouse, when now that space is going to sit vacant because no one needs that much office. So we've bought buildings that have low occupancy, gone in, ripped out a bunch of office, turned it back into more flex spaces, and been able to increase the occupancy by doing that. The other side that was kind of Daniel, to your point, as far as exterior upgrades, we do a lot of new landscaping, a lot of exterior painting, putting on new roofs, sealing and striping the parking lots. A lot of kind of legacy owners sit on cruise control in these properties. They're cash flowing well, maybe they're paid off. They're just not really as concerned with keeping up the look of it. And also there's a little bit of a, not really stigma, but just kind of a thought process that a lot of industrial owners have where it's like, well, it's industrial real estate, it doesn't have to be pretty. And while it doesn't have to look amazing, this is where someone goes to work every single day. And if you can make it nicer, if you can make it more pretty, you can get better rates, and you'll have better occupancy, and people would rather be at your buildings than the others. So those are kind of the two larger renovation pieces that we do. The biggest piece of all of Flex Industrial is the supply and demand imbalance. So as we talked about, no one's really built much flex spaces in the Southeast, and that will continue because of the fact that numbers currently don't work to build more of this space. Cost to construct is anywhere from $150 square feet, really up to $180. Most of the markets we play in are anywhere from $8 to $12 a square foot triple net, which would mean that you're building to I have an example there, like 6-7 yield on cost, which is negatively leveraged. So your debt would actually be higher than your yield on cost will be, which no one's going to build that. So as demand continues to increase, supply will remain stagnant, which will push up rental rates long term, which is what we're seeing. There's an interesting CoStar report that came out, February 7th of this year. And it talked about how for under 25,000 square feet, buildings or spaces of under 25,000 square feet comprise 29% of industrial space in the US, but less than 2% of the industrial space under construction is that small. So it just goes to show that there's tons of this space out there, this older product, but there's no new product coming on the ground. So as that demand continues to increase again, supply remains stagnant, we continue to see rents increase, which has been great. This talks just further from that same article, but it's just showing that pretty much all the new development in industrial is 100,000 square feet plus. That's where you see all the building coming in. And that's true now, pretty much all markets that we see. I mean, you drive around, you see a lot of new industrial coming in, but it's all large Amazon, large distribution center, large manufacturing facility. It's not small office warehouses.
I kind of wanted to pick your mind on that for a moment. Why
Yeah.
do you mentioned the square footage cost to build versus square footage cost to acquire and add value? Why is there such a large discrepancy in the market right now between the building cost and the purchasing of older product?
Well,
Go
oh,
ahead.
go ahead.
I know
Uh,
there's a lot of macroeconomic reasons that could be, but
yeah.
what are your thoughts there?
So obviously you've had construction prices explode over the past 4 to 5 years through COVID. At the same time, you've had rents start to push, but rents a lot of times will trail construction prices. And so it just will take time for the markets to catch up. We believe that long term, you will start seeing new construction be built. Like I said, we're in markets that are $12 a square foot triple net for our space, the older, maybe 30-year-old space. As that starts to creep up to 14, 15, if the rents need to be 17, 18, like someone might come in and start putting on new product on the ground at that point. Eventually it will get there. The demand is high enough that as rents continue to increase, someone will kind of bite that bullet and take the risk to go put new product on the ground, which actually will work out really well for us. I mean, we'll own at that time, it'll be in 2 or 3 years, is kind of our estimation. We will own 1 million square feet of flex. If we're sitting next door at $12 a square foot, someone comes and builds a new building that's 18 bucks a foot, we can push to 14, 15, still be undercutting the new guy, and we just increase the value of our building by 40%.
Yeah, yeah.
So that's kind of our thought there. But I mean, construction prices usually, to your question though, that we just don't really see construction prices come down usually, even through GFC. I mean, if you look at a long-term chart, it doesn't really fall off a cliff like you would think it would. So, I mean, I think long-term construction prices are going to be high and rents will have to get to a place where it makes sense to build new product.
So really, the trend is towards these larger mega warehouses that can command a premium price and make sure that they can, have a business reason for spending that larger amount per square foot.
Well,
So
and it's
it,
also those are a little bit different on the risk parameters. I mean, if
yeah,
you're
yeah.
building an Amazon build to suit, you have Amazon on the hook already for that lease when you go to build that product. For these, you're not a lot of these are regional tenants, so you're not going to pre-lease this building. So when you go put this building on the ground, you're going to have to lease up after you deliver it. So you don't know who your tenants are going to be on the front end like you would, excuse me,
Yeah.
like a bulk kind of deal.
That actually flows well into a question that Henry's asking in the chat here, and he's asking how long are the leases typically?
Typically 3 to 5 years.
3 to 5 years.
Mhm.
And do they have built-in escalation in rents
So we
that period?
traditionally see about 3% built in a
3%.
year.
Okay.
Um, Certain markets like Atlanta Metro gets to 4 to 5% just because that's a really hot market. But industry standard right now is about 3. It used to be 1 to 2 and prior to 2020. So it is nice to be able to get a little bit higher these days.
Yep. Yep. All right. I'll let you go on for a little bit and just know we've got a bunch of questions waiting.
Sounds great. Like it. It's much better than the some groups I talk to that no one has any questions. So it's nice that you guys have questions. It's kind of fun. This is just kind of talking about Class B industrial, which is another word for flex industrial. This is from last year's delinquency notice on CMBS debt, but as you can see, industrial is the lowest next to self-storage. So I mean, very, very stable asset class. Our target criteria is the Southeast. Obviously, there's a ton of in-migration coming to these markets. As people have kind of changed how they work through COVID, you're seeing a lot more population growth of people coming into like Little Rock, Arkansas that traditionally wouldn't be looking in a place like that. So that's really where we target. And it's also the markets that we know. We're, again, located in Alabama. We know the Carolinas, Georgia, Arkansas, Florida. We know all those markets really well. This is just kind of talking about GDP growth of the Southeast. But yeah, and we can kind of jump into some case studies now. Or Daniel, do you want to go over some more questions first, or what's the easiest way?
Oh, whatever you want to do. Let's
Yeah,
go to questions actually.
yeah, that'd be great.
Unless you don't want to do that, I'll let you choose that.
No, that's great. Let's do it.
Okay. All right. Let's see here. What do we have? Paulette is asking, what are the typical deal sizes, and are they in a fund? If in a fund, how many states are you targeting in your fund? I added in your fund, but
No
how many
worries.
states are you targeting?
We do both. So we do individual asset syndications as well as we do have a closed-ended fund that we're currently raising for. We will actually put the two together a decent amount. We found that some investors like to go directly into a deal and kind of be in the more single asset syndication. Some people prefer the diversification of a closed-ended fund. So for instance, we bought a deal in McDonough, Georgia that we'll go over here in a second, but the total equity need was $2 million. We brought 1.2 million from our fund and then $800,000 from an institutional investor that just wanted to go direct into it. So we'll kind of marry those up together, and they invest alongside each other pari passu. So all the investors get the same return. It's just a good way to be able to offer both. Our typical deal size though is 5 to 15 million. So anywhere in between there, and that's usually 50,000 to 150,000 square feet.
Just out of curiosity, do you allow 1031 exchanges from individual investors into your deals, or is that
We
is
will. We'll need to know up front. We don't have like a really solid tick like fund that some people will have that are a little bit more established. I mean, we've done it and we will do it. If someone came to us and said, "Hey, we really like what you guys are doing. We're gonna have a 1031 in 6 months," and we can kind of get in front of it because there is a little bit more of a little bit
yeah,
more legal structure we had to put in. But yeah, 100%. I mean,
yeah,
just to be completely frank with everyone, we probably wouldn't do that for a $50,000 share, which is our typical minimum in our fund. But if someone has 250, 500 or something like that, they wanted to look to do that, we'd be open to it.
yeah. And for those of you who are here and want to know more about how to 1031 exchange into something like this, I think I did a talk about 2.5 years ago on how that tick structure works, and at least in a multifamily property,
And
and
it's the same way.
it's
Yeah,
going
it
to be
works the same way.
similar here too.
Yeah.
Yeah.
100%.
Okay.
As far as the states go, real fast, I didn't answer that. So we're investing throughout the entire Southeast. So we'll currently hold in 6 states. Overall, once we're built out this portfolio, we'll probably be about 10 states.
Okay. Great. Let's see. What's your minimum investment? I think you just answered that, right?
Yeah, 50,000.
50,000. Okay.
All accredited investors.
Glenn is asking, what's your exit strategy? Are you a design construction service? And I'm sorry, and are you a design construction service firm for the tenants, or are they doing their own remodeling? I think we talked about that a little bit. But
Yeah.
what's your exit strategy?
Exit strategy. So it is not a roll up where we feel like we're going to sell this entire portfolio to one large institutional investor. It's just Flex Industrial hasn't gotten to that point. We will bundle up certain markets and sell those off to larger investors. Obviously, that's going to be more of a core plus investor than we are. We're a value add firm, so we're going to take most of the meat off the bone, but there will still be upside through rent escalations over time and as markets grow. So we see these being sold more so to more regional PE shops that are maybe have a little bit more of a conservative investment approach than we do.
Is the follow-up question to that would be, what's your typical hold time?
So we started investing in 21. We have not divested of any of our assets yet, just because our typical hold time is 5 years. And so we'll look to start selling stuff in 26.
Okay. Let's see. Mike is asking, what is the minimum size for a flex complex? Okay, so what's the minimum size building you're willing to acquire?
We've gone down to 20,000 square feet, but that was more of a strategic play on like a bolt-on. We really would like to be 40 to 50,000 minimum. But if it's a great deal, we've bought 30s, but I mean, we really like kind of larger properties.
Okay. And what's the overall cost to a typical value add for a building for for one of your typical deals?
Yeah, our typical all-in price is $93 a square feet on average. So we bought deals at maybe $64 a foot, but we had to put a lot of money into it. So I think our all-in on that one was $88 a foot. But we also bought deals at $102 a square feet. That was a little bit more stabilized, that had higher rents.
Okay. Okay.
But on average, 93.
What sort of insurance do you carry? Ramesh is asking.
We have property insurance, just normal real estate property insurance is definitely an issue right now. Anyone who invests in the Southeast can tell you that insurance is a problem. One good thing that we have going for us is that most of these are triple net leases. We're passing that expense and that increase onto our tenant. While I do say that, I mean, there is only so much that a tenant can pay per month. I mean, that they can afford. So that sounds really easy to be like, oh, the tenants will pay for it. It's not our problem. But eventually it will creep into how much you can push rent just based on the fact that maybe a tenant can only afford $5,000 a month, regardless of whether that's a pass through or their rent. That's just what they can afford.
Yep. Yep. It's like Airbnbs that are charging large cleaning fees. There's only so
Yeah,
much you can push those, even if you're passing it through.
100%.
All right. Relative to retail, large industrial, and storage, so relative to some of the other asset classes that are in the markets that you're currently in, how do you see the cap rate of industrial properties relative to these other asset classes?
It's pretty similar to service-based retail. If anyone invests in like strip centers, it's around an 8 cap is kind of the stabilized average, I would say. I mean, you get into like in Atlanta, you can trade in the lower sevens on a cap rate. You get a little bit more tertiary, you might be up in the 8.5 kind of range. But it's very similar investing structure, very similar strategy as service-based retail as well. As far as the larger industrial stuff, that trades for way lower cap rate, primarily because it's a lot easier on the management side. Big single tenant, 300,000 square foot, 15-year triple net lease with Hitachi tools is a lot easier to manage than 30 tenants that are 2,000 to 5,000 square feet. So our cap rates are going to be higher because of that.
All right. And Glenn is asking, given these smaller locations and smaller businesses that drive a lot of your client targets, what is your default rate, or have you defaulted?
We have not. Let me think about that. We've had one tenant default. I take it back. We've had two tenants default. We had one in Louisville, Kentucky, that was like 1,000 square foot little general contractor that went out of business. And then we had one in the Jackson, Mississippi metro that frankly just bit off too much that he could chew before we came in and bought it. And he was default when we bought the building. We knew that going in. But he had leased about 9,000 feet. He really needed about 2,500 square feet. And he just overextended himself. So that's what it is.
I guess the follow-up question to that would be then, what do your turnover times look like? And, if you have an apartment unit, you can go through, paint it, recarpet it, and do that in a week or so and put a new tenant in there. It's a little more involved here with these industrial spaces. What does that look like?
It is a little bit more involved. And also, I mean, there's not, everyone needs a place to live. Not everyone has to have an industrial facility, right? So our typical kind of what we underwrite is anywhere from 4 to 6 months on turnover.
Okay. Okay. All right. And I think I made it through all the questions here. So if you have more, feel free to put them in the chat. And Grant, go ahead with the presentation.
Certainly. Sorry, let me grab a pen. So we're going to go over a quick case study of this is a property that we've owned for a little while. And then we're going to go over a deal that we just bought, just kind of going over our strategies here. So this is a property in Ridgeland, Mississippi. It's 56,000 square feet. This is the one I mentioned that's right next to a brand new Costco and a brand new Chick-fil-A that are right up the street, which are just kind of long-term tailwinds we want to see going on in the market. New development of multifamilies right around the corner as well. So just showing that the market's increasing around our little facility here. We put new roofs on. We redid the parking lots. And then we mainly redid the interiors of those units. We bought this property with 74% occupied because it had way too much office, and pretty much every one of the vacancies was maybe 80 or 90% office. We've been going through and ripping out office space and turning it back into more 50-50 flex kind of spaces. This says 88%. We have signed a lease that has not moved in yet, or two leases that have not moved in yet. And once they move in, we'll be at 94%. So from about 18 to 24 months, we went from 74% occupied to 94% occupancy just by ripping out office space and turning it into some more warehouse. There's some more pictures of that property. This is the one actually that CVS is located in, as well as the tenant mix. We have a lot of couple of general contractors, home flipper, real estate kind of guy. Cintas is the anchor tenant of this property. They own, or they have this entire building up here on the north side of the property. They occupy that entire building. And then we have just a big, I'm trying to think of some other tenants we have in there. We have Jam Pro, which is a janitorial service, a logistics company, e-commerce company. So a real diverse group of tenants here in this building.
Just maybe this is a little off topic, but when you say Centos, are you referring to the operating system group, or is that a different group? Okay,
that's a different group. Trying to think like the uniform company. Yeah.
Like I see.
Yeah,
okay.
Yes, sir. And they do their safety equipment out of our building. But yeah, this has been a great property for us. Again, we've taken the occupancy up tremendously. And I think long term, that's going to be a really great hold for us. This is kind of just showing where we've taken the property NOI wise, as well as occupancy over the last, 18 months now. So about 16% increase on NOI. Rental rates were signing much higher. We underwrote this deal at about 1050 a square foot was what we thought market rate would be. We've signed multiples 12 pluses. So seeing a lot of upward trajectory on the rents, which has been great. And we'll continue to be able to push NOI by doing that. This kind of just looking at what the renovations look like from the outside. So obviously roofs were in rough space. Parking lots needed a lot of work. A lot of TLC needed to be done. So it looks a lot better now. And our asset management team did a good job on that. This is a deal that we just bought through our fund in McDonough, Georgia. So we'll kind of just walk through what our strategy is here. This is 90,000 square feet. We paid $64.50 a square foot to buy at purchase price. We bought it from some legacy owners, some older gentlemen who built this in the late 90s. Their basis is so low in it that they were renting about $5 a square foot modified gross. We're signing renewals at $12.50 triple net. So we have people renewing at 4 times or 5 times what they were paying originally. And that's just based on the fact that you have very little vacancy. There's nowhere really to go. And also we're going in and while it's a large increase to your tenant, it is a market rent. So it's one of those where like market's $12 a foot. You can either pay us $12 a foot and stay where you are, or you can pay $10,000 to move. And if there's a space available, they will also be $12 a foot. So it's just getting people to market and kind of the new normals. Because of that, this deal is a lot lower on average cash on cash. As you'll see, it's about 5.3% average cash on cash. But the IRR is about a 23 to net to the investor because of how much upside there is there in this deal. It lays out like this, so that it's not this center building here, but it's these 5 buildings. It's 90,000 square feet, has really nice truck courts in the rear, nice brick facade on the front end. But yeah, that will be one of our better deals. I feel that'll be a really good one. We've done it, I guess, for about 3 months now, so been excited about it.
Just to mention this, we got 10 minutes left in the meeting. And
okay, cool.
We got a couple of people that are interested in some of your fund metrics.
Yeah. Sorry, fund metrics.
Although don't let me throw your presentation if that's not here.
Oh, no, you're good. So as far as target returns and that kind of thing on our fund, we are targeting 7 to 8% average cash on cash in our fund, 15 plus IRR net to the investor. It's a 5-year closed-ended fund. So it'll be about a 1.7, 1.8 times equity multiple. We launched the fund in January of 24. It'll raise money until December of 24, and we will buy assets until Q2 of 25. We will dispose of all our assets by December, December of 28. So it's 5-year life cycle. We will buy approximately 7 to 11 assets. Again, mainly 1980s to 2000 vintage that has some upside. Is kind of what we would do.
Okay. I'll let you go on for another 5 to 7 minutes, and then unless that's the end of your presentation.
That's the end of my presentation. So,
all right. Paulette is asking, can you talk a little bit about your perspective on why flex industrial versus other assets?
It's just supply and demand at the end of the day. I mean, we have that's investing 101, right? It's one of the only asset classes that we have not seen boom over the past few years. We've seen a ton of multifamily come in, ton of self-storage, big box retail, big box industrial, but there's just not been any of this asset class built.
Certainly takes a certain level of expertise to own and to operate these that you have to acquire over time. It makes a better barrier to entry, I would think, into the market as well.
It does, and it's definitely more nuanced. I mean, they're not the most simple buildings to own. So I mean, you have to kind of know what you're doing a little bit more, which is great for us because it's a barrier to entry.
All right, and then do you have a single K1 for your funds, or
we do have a single K1 for our fund? Okay. Obviously, if you're in a syndication,
all the investors always want to know about that.
Yeah, exactly. It makes life a lot easier. Thank you, Glenn.
All right. Oh, that was Prolette actually, but
okay.
Glenn is the next question there on the list. Yeah. Given that you mentioned vintage properties with no debt, what's your return structure for investors? And maybe that's what you just mentioned there. You said equity, assuming cash flows are immediate to / soon, or is there a significant time before returns to do the value add phase?
Yeah. So I'm sorry if I misspoke. We do not hold any assets with no debt. We do have debt on all of our assets. we obviously guarantee that ourselves, not our LPs, but we do have debt on our assets. On the cash flow, if you're in our fund, cash flows will start Q1 of 25 after we've closed out the fund and it is cash flowing. If you're in a single one of our deals, then we will have deals that don't cash flow for maybe the first year or two. Or sometimes we'll see return structures for the first year or two is maybe 4 or 5%, and that builds to 9 to 10 over the whole period as it is value add. So like that McDonough deal, for instance, that we went over, that one will not cash flow for the first 18 to 20 months. Just as because it's going to take a while to get more stabilized. So we make sure to have plenty of reserves and plenty of runway to be able to get to stabilization.
How do you go about scouting for these properties? Is there I mean, are you just evaluating everything the brokers are sending within a particular market, or do you have a methodology to narrow the focus?
Yeah, so we have a methodology. So we have selected our top markets that we go into. So before we enter a new market, we go through and we database the market based on CoStar, Crexi, Google Earth, and our analysts put together a list of, hey, these are the 40 to 100 properties in this MSA that we want to own. We then go and find whatever broker is running with most of the flex industrial. That is one good thing about flex is that is still very localized. So you don't have like one broker sitting in New York that's selling throughout the Southeast. It's if you're selling flex in Knoxville, Tennessee, you live in Knoxville, Tennessee. And so we can go and find that guy, send him our list, and it makes it really easy to be like, hey, here are the 50 buildings. If you can get us the information on these 50, we will make an offer. And so we have a really great broker network. And so, as I mentioned before, we buy most of our properties off market, but through brokers because they know what we're looking for and we see first look.
Okay. At this point, there's no more questions in the chat, but if you have a question and you want to take yourself off mute, Proet just put another one in there, but I'll keep it going. If you have a question and you want to take yourselves off mute in order to ask it, feel free to do so.
On that one question, Proet, it's about multifamily and then storage, then RV, and now flex. I do think eventually flex could get oversaturated. I think every asset class goes through a time frame where it ends up being oversaturated, but we have a really long way to go. And you really don't see that until you can build a property positively cash flowing day one based on rents and be able to sell it at CO immediately. That's what happened with RVs. That's what happened with storage is that you could build it for $100 a square foot on storage, for instance, $100 a square foot and sell it day one for $115 a square foot. These properties are kind of the opposite at the moment. So we feel like we have a lot more runway to be able to really dig a foothold into here. Not saying that won't get overheated eventually, but we have a long way to go before we get to that.
Do you think it extends the amount of time that it takes to go through these cycles because you've got, very long leases and it causes the whole industry to maybe move I would say more inefficiently, which is good in my opinion from an investor's point of view. But
yeah.
Do you think it has to do with longer lease times or
100%. I mean, you think about that on the storage side. I mean, we own 4 storage assets. So I'll speak to that just because I know that asset class. And you can roll all your tenants every single month if you wanted to on rental rates. You can't do that on these properties. They're not super long leases, but I mean, it takes 2 to 3 years to really roll a rent roll on a property. You can't do it overnight.
Okay. Glenn's asking about your governmental or regulatory risk.
Yeah. So governmental risk, you do have some of that on the new building construction side. I mean, obviously, a lot of municipalities don't love industrial in certain areas. With that said, these kind of properties do supply jobs, so you will see municipalities be okay with these and like these assets. But also, we're buying existing properties, so we don't really have to deal that much with government agencies. We're not, getting site plan approvals or anything like that.
And actually, I like Prolet's question here. Do you think Flex will be impacted by the event of an economic downturn? And I want to add to that. Can you give us a little bit? The supply chain has been crazy, obviously, throughout COVID, slowing down and then kind of normalizing. What do you see going on? What do you see going on in the supply chain and how's that affecting you?
It definitely does affect us just from the simple fact that you do have more construction companies that work with us that will store more product than they used to, which actually helps us out on the warehouse side. We have seen that for multiple tenants. On the economic downturn itself, I mean, obviously, the economic downturn hurts all industries. I think any industry that says that they're completely immune is frankly lying, to be honest with you. But it will hurt us. I mean, when small businesses hurt, these properties can hurt. The one thing we do like about these is that maybe UPS will just say they might go dark on 30 properties and they won't blink an eye or think about it. Our tenant Bob's HVAC service. Bob needs to feed his family. That's his only location. He's going to be a lot harder pressed to give up his location to default than maybe a big Fortune 500 that's okay just getting out of a bunch of leases and not thinking twice about it. So I do like that from an economic downturn standpoint.
Okay. We've got 3 minutes left here. Does anybody else have any questions for Grant?
And yes, Jason, that was Crexy that I mentioned. Sorry.
Yeah. All right then. Hey, go ahead, Jason.
No, I appreciate that. I'm trying to catch up, right? I'm a little behind on some of the tools and apps of today's market space analysis for what you're trying to accomplish. I'm really excited at all the stuff you're doing down there. It is a niche market though, but it's definitely paying off well for you guys. Congratulations.
Thank you. Appreciate that. All right.
Could we have everybody here take themselves off mute and thank Grant for coming in and speaking to us today?
Thanks, Grant.
Thank you.
Thank you.
Thank you, Grant.
Thank you.
Thank you, Grant.
Thank you, everyone, for having me. It's fun talk. Like I said, I speak to a lot of groups that no one asks any questions, and so it's great.
It is nice to have active feedback, isn't it? I like it that way too.
Yeah, it's great.
And I love this group because they ask so many questions and are just in general very participatory.
Yeah, no, it's been great. Really appreciate it.
All right, Grant, have a wonderful weekend, and everybody else here have a wonderful weekend as well. And I will see you next week.
And
Cheers.
for those of you who are inclined, happy Father's Day to y'all.
Yes, happy Father's Day. Good one.